The second largest bank failure in American history just wrapped up. The third and fourth were a mere month ago, with First Republic being sold to the largest bank in America, J.P. Morgan. Morgan said it will take on all of First Republic's deposits, it's about $92 billion, and most of its assets amounting to $203 billion. Morgan is actually paying, which is a nice change. We, the taxpayers, don't have to pay them to take it on. They're paying $10.6 billion, but it actually books a profit immediately, $2.5 billion in fact, since the FDIC is sweetening the deal, meaning you are sweetening the deal, with $13 billion in shared losses on the loans, plus $50 billion in fresh financing. So the FDIC's threadbare coverage, already scrounging to just 0.6% of all deposits, gets even thinner. Note, the FDIC already lost, meaning you already lost, $22.5 billion on Silicon Valley Bank, most of which, $19 billion, will be converted into what the FDIC calls a special assessment, which is a tax on your bank account. They're going to take that nice and slow over the next 4 years, presumably so you don't notice. After all, you don't shear the sheep all at once. Now, Morgan taking on all deposits does avoid the uncomfortable conversation whether indeed all rich depositors in America have been pre-bailed out by Janet Yellen, which would trigger the mother of all special assessments. And so when the smoke clears, yet another fast-living bank found a new home, and it only cost you $63 billion paid to the largest bank in America. As predicted, the $30 billion injected by major banks a few weeks ago was all covered. Now attention turns to the other regional banks, some of which are in almost as dire shape. In particular, Western Alliance, $69 billion in deposits, and PacWest out of Arizona, $41 billion in deposits. In fact, hundreds of banks, according to a Stanford study, thousands, are in trouble because of the fastest rate hikes in 50 years. These crashed their bonds, impaired their loans, and vaporized the easy profits they were making paying depositors pennies. In the words of one analyst, this isn't about individual bank runs, it is a, quote, run on the business model. Unfortunately, essentially every bank in America used that business model, loading up on expensive bonds to park the influx of pandemic-era deposits, and then losing hundreds of billions as rates went up. American banks are now sitting on at least $620 billion of unrealized hidden losses. So First Republic was about 5% of that, and we've got 95% to go. So what's next? The Fed meets in 2 days. They're expected to hike rates again to 5%. The market then expects them to stay and chill for a while, and then to actually start cutting rates in November at a steady pace, coming to just 3% in time for the 2024 election. Why flip-flop so fast from hikes to rate cuts? One theory is inflation falls rapidly. Another is the economy gets so bad that the Fed gives up against inflation and just panic cuts. And yet a third, predicted over a year ago by the incomparable Mark Faber, is that the Fed's main goal in life is buying political immunity, economy be damned, and boosting the economy going into the 2024 election buys an awful lot of friends in Washington. Either way, we'll be watching. See you next time.